Hello, I'm David Cassidy with the market summary for the week ending Friday, the 19th of February. As you can see from the accompanying table, over the week, equity markets were little changed. However, of more interest is the fact that it was this time last year that equity markets began to fall as coronavirus, which until then was seen as being contained in Wuhan, started to spread outside of China. Almost overnight, it changed the world dramatically, while the unprecedented lockdowns on global activity in order to stop the spread of the coronavirus resulted in equity markets around the world falling sharply. For example, the FTSE 100 index, which stood at 7,457.02 on the 19th of February 2020, quickly fell to just below 5,000, a fall of nearly 35%. Although at the time we consistently argued that it was important to resist the urge for any knee-jerk reactions and maintain a long-term perspective as the coronavirus outbreak was a transient issue, in reality we know that for our clients this was easier said than done. However, 1 year on and global equity markets have thankfully started to recover, with the FTSE 100 index closing on Friday the 19th of February 2021 at 6,624.02, which means the FTSE 100 is now only 11.17% lower than this time last year. Now, although our portfolios were by no means immune from losses, our disciplined investment processes and active global investment management approach did help to protect against bigger losses. And over the same 12-month period, a typical client cautious risk portfolio is up 2.33%, balanced down just 0.31%, and adventurous up 5.37%. So back to this week and some important data releases to analyse from the US, given the recent talk that inflation and interest rates will soon increase or the US doesn't need President Joe Biden's proposed $1.9 trillion fiscal stimulus package. As regular observers of our commentaries will know, we disagree with this. And thankfully, last week we weren't left wanting. First off was a score for growth. US retail sales smashed expectations, rising by a whopping 5.3% in January, way more than the 1.1% major economists had expected, while US industrial production, which includes output from factories, mines and utilities, grew by 0.9%, which means it is now within spitting distance of the pre-coronavirus levels. However, the need for low interest rates and more fiscal stimulus was laid bare for us all to see in the US weekly jobless claims data. Not only did initial claims for unemployment benefit come in nearly 90,000 more than economists expected, but it came in higher than the previous week's reading, which itself was revised upwards, which is bad, by 55,000. As we've previously stated, the US Central Bank has a dual mandate of inflation and maximum employment, hence why we don't see interest rates changing any time soon. While headline inflation will rise in the coming months thanks to the distorted oil price and now thanks to the unprecedented cold weather in the US, we may temporarily see higher food prices as crops will have undoubtedly been lost. The underlying inflation pressures are modest and are likely to remain so as long as US unemployment remains high. Thankfully, our views chime with those of Eric Rosengren, the president of the Federal Reserve Bank of Boston, who this week poo-pooed inflation fears, saying he doesn't expect to see a sustained above target 2% inflation rate. Looking to what's ahead this week, we have UK employment data, unemployment rate and weekly earnings, and US jobless claims, the Chicago Fed National Activity Index, US durable goods orders, the Fed's preferred inflation measure, and PCE, and Japanese industrial production.